So, guys, it's kind of fun and exciting to be sitting here in January of 2024 together. Because when I think back on, RREAF and how it started and where we've...
It's actually 14 years this month.
Yeah, that's
right.
Crazy to imagine. Yeah. And, when you really think about it, we talk about the roots going back 37 years.
Right.
It really started, I think, with me in commercial real estate. After graduating from University of Texas in Austin in '85 and going to work for Lomas & Nettleton in the real estate investment banking division, and figuring out pretty early that how much I enjoyed the commercial real estate space and really wanted to build something unique and different from than a big institution. And so
and quit making so much money for all your clients.
Well, that's right. But you got to remember too that the really beginnings were really more as a mortgage banking company.
Right.
Doing debt placements and equity raises for institutional capital and investment sales.
Mm-hmm.
But it was nice starting out back in those days and having some very large institutions that would hire us to transact on their behalf. We were, in those days, selling for some of the largest institutional real estate owners in the country. I think Equitable Real Estate was probably the largest, and we transacted billions of dollars for them. But as Graham pointed out, I learned real early that you're only as good as your next assignment.
That's right.
And you're not really building anything.
That's right.
And so, fast forward many years later with the idea of setting up, RREAF Holdings with good friends and son Graham and Mitch and I actually go back to,
1981.
So what is that?
Closing in on 42 years.
42 years. Yeah, I think Mitch and I, we go back 40 plus years, back to 1981, I think is when we met.
Closing in on 42 years.
You guys were fraternity brothers, right?
Brothers. Pledge Brothers.
Pledge Brothers.
And I remember...
Mitch probably used to copy all the answers off your test.
That's the only way I got to school.
Yeah, Mitch actually knew where the campus was. I learned where the campus was well after graduating and going back to a football game or two. But and Mitch, you started actually doing some investments with me in the early days.
In the 80s.
Yeah.
80s, RTC days. We did some. Yeah. I did some of your real estate deals back.
Yeah, it turned out real well.
They did turn out good. Nice little triples.
Yeah. Yeah. And then Doug and I, always joke, Doug, how we're kind of brothers from another mother.
That's it. That's it.
I don't know that we could really figure out how we're related, but.
Yes, that's right, Kip. In fact, my wife at the time's brother was married to your wife, Mary Nell's sister.
That's right.
And you and I met for the first time in '05 at Mary Nell's grandmother's 100th birthday.
Yeah, I remember.
And we instantly did not like each other.
That's right.
And that quickly changed, and now we're partners and very, very close friends.
Yeah, you too, just like Mitch, actually started, I think, first investing in some of the deals.
We did.
Early on.
Did.
And then, you were one of those bond traders in Memphis for, 30 years?
I traded for nearly 30 years. My first day on the bond floor was Black Monday.
Wow.
So October 9th, I turned 22 the day before, and I began my bond adventure.
Yeah, we're all dating each other, going back then.
Yeah.
Of course,
you guys know each other longer than I've been alive.
Yeah. That's right. That's right.
So.
Well, you kind of grew up in the business.
I did.
Every ski trip, every vacation, hearing me talk on the phone.
Every time sitting in the car, just listening to you slinging deals.
Well, it's been fun, and it really amazes me more than anything to think that, I don't know, 5 years ago we maybe 6 years ago hit $100 million in assets, and to see how I remember the big milestone was getting to $100 million. Couldn't wait to have $100 million of assets that we own. And then, then it was half a billion.
Yeah.
A huge milestone.
Yeah.
And then a billion. And then it just, today at 4.5 billion just blows my mind.
And growing.
And
So
growing.
fast.
Yeah.
So fast. And
It'll
we
be-
built such a wonderful culture.
And it'll be 12 months, 18 months before we're at 10.
Yeah. Yeah. It's a great space. Been a lot of fun to grow the way we have over the last 10 years. I guess we were officially started in 2010.
I think January of 10. Yeah,
Yeah,
14
so they
years.
just
doing this
make
a
it
little earlier than that.
Yeah,
but,
yeah,
we founded
right,
RREAF
right.
January of 10.
Right,
Yeah.
right.
Yeah. It's funny too, thinking that, where RREAF is today was a lot different, not just from a size standpoint, but from a focus standpoint.
Right, business model.
Yeah,
Yeah.
I think back then we were thinking that we would see the RTC type 2
That's right.
again. And, I think we all got so well educated on real estate in the South and Southeast from, meeting with some 80 or 100 community regional banks and underwriting their real estate portfolio. At the time, recall, we were thinking that we were going to be focused on buying notes secured by real
That's right.
estate and doing workouts. And, I often say that that's, in my opinion, one of the few things that government got right.
Well, hopefully I guess they learned a lesson from RTC days in the 80s, and they didn't really make the banks dump those assets onto the markets. Instead, they allowed the banks to hold those assets.
Yeah.
But as a result of that, I mean, I remember going to those reviews. I mean, we
Yeah.
went to bank after bank after bank, but we formed phenomenal relationships
Yeah,
with
that's
all
right.
those banks. And that started really helping us, Mitch, the platform that you run, that was one of our first, I guess, opportunities with one of these banks that we formed a relationship with, picking up Beachside.
Yeah, I think
Yeah.
that's
Yeah.
a really good story, actually.
Yeah, it is.
What came out of all of those meetings and learning what was happening in the market was
We started getting the first phone calls from those opportunities.
the very first deal that
Yeah.
you all did as RREAF being Beachside Resort.
Yeah.
Was that really the first deal?
No,
Well,
that was a second.
It was
Second
the second
deal.
deal. The first deal was the land deal.
Yeah,
up in
Gallatin, Tennessee.
Up in
Yeah.
Tennessee. But
Yeah.
first hard asset
Was Beachside
yeah,
Resort.
Beachside Resort.
I can't even remember what,
We paid $47,000 a room
Yeah.
for beachside, and you can't build on the beach for less than $500,000 today.
yeah.
I think you all ought to tell that story.
Yeah, I think you should.
And our total basis in it, excluding my sweat and blood, is about $73,000 a key.
Yeah.
Yeah.
It's really not much.
What's neat about that deal, we've returned the equity investors' money 3 times or more, and it continues just to be just a
Yeah.
cash
Yeah.
cash
No
cow
reason to
for
sell
I
it.
mean, we're
Yeah.
throwing off over a 20% cash on cash.
and got very low leverage on it.
Cash
now.
on cost. Oh, yeah. It's like a 22 cash on cost.
Yeah.
It's unreal.
Yeah.
And we've been able to replicate that many times over in the beachfront vertical as well.
Yeah, I think that really works well, when you're buying a property, an older property, and you are really changing the whole dynamic and complexion of it through heavy CapEx, not only, interior and exterior, but everything that's being done, on
Professional management.
professional management, buying from mom pops and,
Yeah.
assets that have perhaps been in the family for,
That's
20,
right.
30, 40, 50 years, with not a lot of professional management and/or
That's
Well, Beachside Resort was basically an old, dilapidated exterior corridor
was, it
motel.
it was called the Sea Palms. No,
Sea Witch.
Sea Witch.
Sea Witch Motel.
Sea Witch is a clipper ship, and it was on the glass doors on the front. It's
Yeah,
gone
I
now.
remember that. I
But,
do remember that.
But if you remember that deal, somebody bought it for the land,
That's right.
paid almost $31 million just for the land,
Yeah.
and we bought it for 6.25 from the bank.
Yeah.
Yeah.
And they
So
put
it was
$9 million in it,
They had a
entitlements
lot,
and
they had a
everything
full set of
else.
plans to go
Yeah.
vertical with
Yeah.
384 condo units.
30-story condominium
Then the
tower.
world changed. Financial crisis hit. And,
Yeah.
yeah.
And never got torn down. They never put the owners never put money back into it because they were just going to tear it down.
Right.
They didn't even look at it for cash flow.
No.
So it was full of, I won't tell you what was living there.
Well, y'all
was
picked
Full
it
of
up.
asbestos, full of mold, everything else.
Y'all
We-
picked it up from the third
Next
lead
bank.
participant
Yeah.
bank.
Yeah, next bank.
At
Yeah.
the first two banks actually failed. And he, Jim at Next Bank, he ended up holding the note on this and called. I remember this. He called Kip. He said, Kip, I need you. I got an asset down on the panhandle of Florida I've never seen. Don't want to go see it. Full of asbestos, full of mold. I do not want to be chained to title. I need you to go see it.
I remember what I said
I think
to
we
him.
hopped down the next. Hold on. We hopped down the next day, toured it. I wasn't there. You guys toured it.
Yeah.
Even though I was a part of the team, I wasn't with you. But y'all came back, and then you talked to Jim, and you said,
Yeah, I said, I got good news and bad
That's
news.
right.
I've got good news and bad news. He said, I said, the good news is we'll buy the asset and get you out of chain of title.
right,
He said, what's the bad news? I said, well, I don't think you're going to like our price.
right, right.
But at the end of the day,
So we paid a little over 6, put a little over 4 in it, right?
About $10.5 million.
$10.5 million
all in.
fully
And this was
capitalized.
a full gut and renovation, taking it down to the studs
much.
and the frame,
Yeah.
basically.
Bought all the furniture out of the Sheraton down here.
Yeah.
Trucked it
I
down
remember
there.
that.
Good furniture.
Wasn't well, yeah, yeah,
We've changed it since.
yeah,
But,
yeah.
It was
Yeah, but
good
I mean,
furniture.
So the former owner had probably close to $40 million in it, and
Yeah.
we are
completely
now
wiped out.
Yeah, totally wiped out. And now we own Beachside Resort, all in just over 10 million.
Yeah.
And
It's probably worth 30-ish.
30.
Yeah, I was going to say
So,
30, 35
Yeah.
Yeah.
today.
Yeah.
But then, the one right after that, right down the beach, the second one, Bikini Beach,
Bikini Beach.
same kind of deal.
Same story.
great
what,
name.
What was the other? Was Cocoa Beach next?
Cocoa Beach, I think, was the third one.
Yep.
Yeah.
Yeah.
Cocoa Beach.
That little gem now.
Yeah,
Yeah.
that's great.
Yeah.
That's
Higher
it.
cost basis. We talk about what's the 3 most important
Is
things in
that
real
the-
estate.
Yeah. Location, location, location.
basis.
Basis.
Basis. That's right.
That sounds
And
like
that's another
six.
great basis. But is that the one? Is that where you lost the drone?
Well,
No, was that on Cocoa Beach?
I think that was pre-programmed by DJI for it just to fly away so they could sell you another one.
Are we going to talk about losing drones now?
No, we're not going to go to that story. Yeah,
The drone's probably right over there. I didn't lose it. It came back.
it did come back in the mail. That's right.
I think it's
Eventually.
a great story because it really speaks to that platform as a whole. I mean, that platform, how many assets do we have now, Mitch?
Basically, on the beachfront style, there are 8 different assets.
8 different assets.
that's-
Haven't sold any of them.
Three
Don't
of-
really intend
yeah,
to.
3 of them have fully returned all the equity.
Yeah.
The other 3 are in
And
the
the other 5
process,
are on the
or 5 are
process.
in the process. So there was Cocoa was Hutchinson Island in,
Hutchinson,
Hutchinson
and
Island
Surfside.
and Surfside.
Surfside
Yeah.
are a pair together.
Right.
and then there's
The
Amelia.
two
Two
assets
on
in
Amelia,
Amelia.
Ocean Coast.
Yeah.
Yeah,
And then we also bought Sea Palms.
Sea Palms Resort.
Resort.
That was a similar type deal from. It was part of a big portfolio with, was it Arden out of Atlanta?
Argentic.
No, I think it was
There's
Arden.
something it was
Yeah.
Yeah, it was Arden out of
Yeah,
Atlanta.
right.
And they came in a big portfolio, and they just needed to spin this off
That's
because
right.
it wasn't really their business model or business plan. And I think we picked that up at a
Yep.
very attractive price.
Yeah. We've put a lot of
Beautiful
capital back
property.
into it.
Oh yeah,
And it's,
Right across the marsh from Sea Island, and we're making better margins at a lower ADR. So imagine that.
and that's
Yeah.
kind of what the business plan
Yeah,
has
it
always
is.
been, is
Yeah.
catering to middle America. And we can own these, beautiful, but older hotels, but you're sitting there right on the same white beach and blue water as, the Ritz-Carlton down the road.
yeah. I've said many times, that we're, we prefer the guests. Well, they're right down the road. People are flying in their private planes with their Yeti coolers, and our guests are driving in their new Suburbans with igloo coolers.
That's right.
I like that.
Same beach.
Same beach,
Right.
same
Yeah.
water.
But
As I said,
rather than needing $600 a night,
we make
and-
money at 150.
That's
Sure.
right.
right.
That's right.
It's not bad when I see, in the summertime, a lot of these hotels hitting $400 or $500 nights.
Yeah, sure.
They will.
It
They
just,
will.
Sold
it-
out.
it's crazy to me how wonderful that platform's been.
Yeah.
But I
Like-
think maybe that platform really started to form our thesis in
Yeah.
terms of, as a company, serving middle America, serving families,
Yeah.
serving the largest demographic in the
Right.
country.
Which
And-
is
Well,
so
that
often
really-
overlooked.
yeah, and that sort of evolved maybe into what we talk about next, which is really our multifamily.
yeah,
platform.
that's
Our
really
bread and butter.
Yeah, I think that speaks, to RREAF and being able to identify disconnects in a market
Correct.
better than most other groups can, and quicker. You know, I think that we all agreed that, you know, if we started buying, you know, existing multifamily in some of these secondary markets in the South, Southeast where institutional capital had yet to play,
Right.
you know, we're seeing deals that we could buy at 150, you know, basis points higher cap rates if that same deal, you know, was located here.
Right.
And, you know,
The irony of that is that it wasn't cool. It wasn't popular at the time that we were doing it. And there was that big, you know, disconnect in the cap rates. You know,
Institutional capital just wasn't there.
and they weren't there,
Checks
but
were too small.
Right.
That's
Underwriting was too granular.
that's right.
and
It
so
just didn't fit their box.
It was more mom and pop because
That's
there was
right.
no institutional capital, and do exactly what we did on the beachfront
That's right.
hospitality deal. You know, you institutionalize that and you create scale.
and you kind of create a market and you show the rest of the market, hey, we're here, we're doing this, and this hasn't been done before. And I think we created a ton of attention, and more groups started pouring into the space.
Then it made it
And-
difficult for us to buy in that space.
Right.
You know?
Capital is always going to chase yield, right? Even if it becomes more granular, even if it becomes more tactical, and that's what happened in that space. But
Right.
you
I mean,
know,
think of the. I was going to say,
well, I'm just going to say that we performed very, very well in the space. We still are in the space,
Right.
and we continue to grow that platform.
I remember early on, Kip, you know, kind of to me seems like a guru of sorts. Because I remember in 16, 17, 18, when nobody was really doing this, he said, you know, just wait and see.
Yeah, that's right.
You know,
it'll
and
come. You know, again, it's, you know, you're buying from kind of mom and pops that really don't understand how to, you know,
That's right.
manage. And as we always say, guys, I mean, scale matters. Scale matters. And to be able to scale, no matter what it is, you know, in a market, you're creating value, you know, through operations
Right.
and the economies that you realize through that scale. And, you know, having the professional management that knows how to, you know, drive rents and manage expenses to create that, you know, much higher NOI, you know, for your equity investors.
So much,
right. And that,
so much low hanging fruit with these assets when you acquire them because they're so poorly, so inefficiently managed.
That's it.
Right.
Inefficient.
Day one, there's that value that you add.
And then
Right.
when you've scaled and you
Right.
have everybody else coming, you're getting the cap rate
That's
contraction.
right.
So you're getting a double whammy.
That's right.
And that's what's, you know, created, you know, so much value for us.
Right.
and that's, you know, kind of our corporate thesis is, you know, trying to be as vertically integrated as we can and really control our destiny at every level. So, you know, building out the property management company so that we can manage the expenses and the income and having the ability to go downstairs and walk on, you know, knock on Melanie's door and say, what's going on with the occupancy? What's going on with the expenses here? What's happening? And it gives us a lot more control than, you know, a lot of those other smaller, you know, syndicator groups have. And it's
And I also think that the property management company, the way they're trained, they do a lot better job than, in my opinion, than even, you know, big third-party property management.
course.
companies. They're managing NOI
100%.
versus managing just revenue.
right. And they have an alignment of interest,
That's right.
That's right.
right?
That's right. And it's been proven with a lot of doing third-party property management as well, that, you know, that they are out managing
Right.
some of the
Right.
bigger companies.
Yeah. I mean, we give everybody a fair shot. We bid it out, but we've found that our management company is the best performer for this product type and the markets that we participate. So.
Yeah, I agree. You know, and it's, you know, what's next? I mean, we've talked about beachfront hospitality, why that was so great. And, you know, multifamily, we continue to grow that. We're, 62 communities
Yeah.
today and
16,000
15,000,
Yeah.
16,000
Because-
units.
Tremendous amount in the pipeline.
North
Yeah.
of 21,000 at times, but
Yeah.
you know, we took advantage of exiting at just the right time on probably 30 assets and built up an extremely compelling track record.
Yeah, that certainly helped, you know, grow that investor base. I mean,
Sure.
you know, the way we operate and everything else. I've never, you know, you start with, you know, a couple hundred investors and you look up next day and they've told their family, they've told their friends, and you're at 2,000 plus. You know?
Yeah.
You know, I think that's one of the best stories, as far as I'm concerned, for us with our growth. That we are such a large company and we're such a diverse company today, Yet we're still very much fueled by our relationships with our individual investors.
Right.
And they have grown with us. I mean, gosh, that database is probably well over 2,000 in terms of active,
in excess.
in terms of active investors. And then there's many, many thousands above that have gotten to know RREAF, and at some point in time, they'll probably be investors too.
What I
So,
like truly about that is when you see an investor that has one investment at $50,000, a few years later, you see they're at 20 million with you and 20 investments. So obviously, it tells you you're doing something right.
Right.
Well, we hear stories all the time from our investors that say, hey, we used to invest with 10 different sponsors, and we would, put a little money here, a little money there. And, over the past 3 years I've been investing with you, RREAF, I've narrowed that down to just you guys because of the way that you all do business and, the transparency, the communication, and the returns.
Yeah, I was going to say, it doesn't hurt that we've exited 32 deals or 33 deals and, are hitting better than
over
doubles.
a 2 times multiple and over a 23% IRR.
Right.
That certainly helps, but
So
it's really the attention to detail and it's the communication. I mean, I'll say
Right.
communication is more important than anything else.
yeah,
And, and also having the depth and breadth to, the history that we have so
Right.
that, when there's headwinds in real estate like we have today,
Right.
you're a company that knows how to manage through that.
That's right.
I think, some of the opportunities that you're seeing right now are companies or sponsors that were not as well capitalized and or knowledgeable in the space. And
that's right.
They're going to have some issues.
right.
There's a lot of those groups, and I call them pop-up syndicators that came into the space and saw all of these, traditionally well-experienced groups making money in the multifamily arena and decided to try their hand and were able to build up and amass large portfolios, but didn't have really the operational expertise that we do. And, some of the decision-making that was going on was to the detriment of, some of those deals. And so, we're just now starting to see some of the blowback from that, and it's creating a lot of really good opportunities for us to buy.
Yeah.
It takes a little time for the stress from higher interest rates to build up.
right.
That's right.
These deals have to exit.
But we're seeing big portfolios of,
Well, how many-
household names.
How many offers do you have out right now?
Over 82.
So, what's the dollar amount?
Well, it probably $2.5 billion.
Well,
So,
Yeah.
we get half that even.
And the irony of it.
And we're buying it for such a deep discount to where deals were trading, 12, 24 months ago.
Right.
I mean, it makes all the sense in the world what we're seeing. We're buying these deals at the debt, essentially.
And
So-
people are throwing around the D word. I mean, they're saying distress this, distress that. These assets are not distressed.
No. Well,
The capital stack.
The capital stack
so the capital
is the problem.
stack is, but what happens is, these owners are having to siphon off all of their cash flows that would otherwise be used to maintain operations, maintain occupancy, complete turns, and make readies. But they're having to use it for debt service and covering expenses. So it's kind of this downward spiral that a lot of these sponsors are experiencing, where they're not able to generate the cash flow to service the debt, but all the cash flow is going to service the debt, and then they're not able to keep up with your normal operations. And so you can't lease units, you can't make units ready, and it just continues to deteriorate. So a lot of these will have a ton of operational upside where we're going in and getting a deep discount on the basis,
Right.
where all we have to do is come in with a well thought out business plan and with,
Similar to what we've done over the last
Right.
right with and capitalize it correctly and bring in
Correct.
our professional management to bring these deals back to stabilization. And you're creating a ton of value just in doing that without having to implement any sort of a CapEx or value add program. It's just in operations. So
let's not discount either, the area and the region of the country in which we're
Right. It's
Location,
all-
bases.
Yeah.
It's all in the south,
You're
south
checking
and
those boxes.
southeast, where
That's right.
everybody is moving in droves.
Yeah, you've got
Yeah.
so much, demand exceeding, supply that almost anything residential you can't get hurt on. There's waiting list in the number of our, areas. I think that's probably what led us to really launch RREAF Communities.
Right.
Yeah.
I mean, we saw, such a need for housing, particularly in Texas and, quite frankly, the Southeast, but really in Texas because, the population has just exploded here and there's not any kind of housing that, that first-time home buyers can afford.
Right. I was reading yesterday, and I don't know if you all have heard this argument, but I have, and a lot of people are saying that, there's oversupply in, the South, Southeast. People are overbuilding. And, you can't use Austin, Texas and Phoenix, Arizona as, a barometer for the entire South and Southeast.
No.
But, people aren't taking into account that the demand is far exceeding the supply. If you look out in, California or New York, you'll see, yes, the supply in those markets has paced downward, but the demand has exceeded that downward pressure on the supply. So there's not really there's no positive elasticity there like you're seeing in the Sun Belt regions where, yes, there's an increase in supply, but there's an even greater increase in the demand.
That's right.
So
That's right.
the fundamentals remain strong in the South.
And sometimes
and
it gets all thrown into one category nationally with
That's
media.
right. It's not supply. It's
No.
supply and demand.
Correct.
Yeah, no, there's obviously, a ton of new multifamily that's come online in North Texas.
Yeah.
Right.
But the reality is it's going to be absorbed.
It's being
Right.
absorbed. That's
And-
right.
Well, and an even greater problem is that we saw new development starts down so much during 22
That's
and
only
23.
going to exacerbate that demand.
And it's not going to hit until 25, 26 when all the new deliveries come online. And, we're going to easily absorb the new supply, but then there's going to be this big lag
That's right.
in new product, for the next 2-3 years.
Yeah,
And
and
so-
sadly, great for us, but for
Right.
the consumers, you're going to see that rental
And
increase,
rents are-
double-digit rental increases
right.
all over again.
but it's
And then
a,
that's when we start exiting.
and
Right.
it's a
Right.
good time to be an owner of multifamily in the South and Southeast.
Absolutely.
Yeah.
Mitch will tell you all day long that, particularly the way RREAF is set up with, our fixed rate debt and that
Right.
being the biggest part of the expense equation. And what happens in inflationary periods?
Oh,
when
it can be really lucrative to hold an asset where you can change your revenue,
Right.
hotels, apartments, with fixed debt. Because yes, your replacement cost is going to go up, your asset value is going to go up, but your basis doesn't change and your debt's not changing.
That's right.
That's right.
your cash
equity's
flow increases.
exploding.
That's right.
Yeah, your cash flow increases, which translates into better yield for the equity investor.
Exactly.
And so
It takes time because cap rate's going to go up, but when inflation gets resolved, cap rate's
Cap
gonna
rates
go
come
down.
back.
You got to pretty much just stay through the whole
That's
cycle.
exactly right.
That's
Well,
right.
so that's kind of, what makes RREAF so special and well positioned for today is that, when we started the multifamily vertical, we all kind of realized where rates were, and they were historically low. And, a lot of our competitors and a lot of our peers would have told us we were crazy for locking in, our 10-year fixed rate money when everybody else was, putting floaters on, expecting the interest rates to stay as low as they were for forever. And it just doesn't work that way. So we kind of foresaw, rates coming back to normal. And, we were able to lock in long-term fixed rate debt across our entire portfolio of multifamily assets, which really gives us an advantage today because, we're not suffering at all. We don't have to sell. We don't have to refinance. We're well positioned to weather, whatever the storm may be.
Yeah. But I'm also thinking we're starting to see, I think we'll see some easing of the interest rates.
I do, and we already have.
And already have. I think we've seen, 100 bip drop in
At
the last.
least.
Yeah.
Yeah.
A little over 100 in the 10-year.
Yeah.
Yeah.
And I think that'll probably continue.
And the Fed fund futures are showing,
We're not seeing it in SOFR yet. But
expectations for the Fed to start cutting at some point this year.
yep.
That'll probably happen. But the bottom line is, if we're buying today and we are trying to buy today, we're still doing fixed rate.
Yeah,
we're not going to
absolutely.
play that. We're not going to play that interest rate game.
Right.
It's just, Graham's a younger one, but the three of us, I mean, we've all been through multiple market cycles. And unfortunately, a lot of the syndicators, as you mentioned, that have done so well in this ultra low rate environment, they really haven't been through cycles.
Right.
And they haven't really experienced what we're now starting to experience.
Well,
Rates and guys, I mean, we all know this. Rates are not high today.
No, they're
Rates
they're
are
not.
normal
That's
today.
right. But you brought a very good point up, and that is that, I think that, and I'm sure Graham's going to pick up and touch on this, and that is that the agencies are realizing, though, that they're not getting really the 10-year money out with where the rates
right.
are, so they're starting to do the 5-year
The
product.
5-year,
right.
right.
And maybe that's how you get your cake and eat it, too.
That's
We
right.
get comfort in our fixed rates today to the extent we're buying them, and we're underwriting with today's rates, right?
Right.
That's
So
right.
maybe it's 5 years, so that in 3 years or 4 years, you don't have a huge prepayment penalty.
That's right.
And if rates come back down,
You only got 2-3 years left on your term.
That's
That's
right.
right.
Less.
That's exactly right.
So, and that's exactly what we're seeing. And, I'm sure a lot of our investors or people who are watching this know that we're select sponsors with Freddie Mac. And so we actually are able to kind of give our insights and give recommendations to the agencies. And that was one of the things that we had been kind of pushing for, was a different source, or not a different source, but a different type of capital or a different type of product where we can lock in shorter term fixed rate debt, knowing that rates may come back down. They may go up. There's going to be volatility
That's right.
in the capital markets for the next 12, 24, 36 months. But with this 5-year fixed rate money, we're locking in,
protecting downside.
we're protecting our
Right.
downside at rates where we're comfortable
Quantifying the risk.
because the acquisitions that we're making.
Right.
And I don't think you're really giving up much of a concession on
No.
a 5-year deal, because
No.
it'll take us, 3 years to really implement the
right.
business plan anyway, or 4 years.
That's right.
That's right.
You know.
And then you can exit at par, or pay your minimal yield maintenance.
Right.
Right.
Where if you're in a 10-year, 12-year loan, that yield maintenance or prepayment penalty is going to be much higher. But with this 5-year money, it makes it a little bit more flexible for groups like ours.
I find it, I don't want to say humorous, but, all this talk about all this supply coming on, I know we touched on it a little earlier, but, we're so bullish on the market and everything else. We've got, 5 apartment communities
Yeah.
under
works.
construction?
Yeah.
Yeah.
Well, both multi,
Beat
for rent and BTR.
Right.
Yeah. Oh, speaking of BTR,
Yeah.
that's something we haven't really talked about. You see these interest rates, raising, and it makes it more difficult for people to buy, entry level homes, but they still might be, part of the segment of the population that doesn't want to live in a multifamily. What do? We provide them houses
That's right.
for rent,
The spread today between the cost of an average home, what that costs per month, all in, taxes, insurance, mortgage payments, everything, versus where average rents are. It's the widest gap it has been
In history.
in many, many years, if not in history.
Yeah.
And you add that, or you layer that in with the fact that it's been a cultural shift as well.
Yeah.
Not just young people,
Right.
but older people too, that have just decided, you know what, I'm going to have more flexibility in my
Home
life.
ownership's hard.
I'm going to travel. I'm going to do this. I'm going to do that. What's that?
Home ownership's hard.
Home ownership is hard. I mean, I was
I just
taught.
bought my first house. It's hard.
Yeah. I was taught as a kid, that's one of the major investments you make.
But
I've
more
got a
people are
clogged toilet.
becoming permanent renters.
100%.
Yeah.
Long-term
Yeah.
renters.
100%.
Because the reality is,
Renters by choice. They
people are
choose
more
to.
mobile.
Right.
If you're not going to be in a house, Graham, if you're not going to stay in your house for more than 5 years, you shouldn't have bought it. Right? It takes about 5 years
He'll learn that.
for the trading costs just to break even.
That's right.
Yeah.
So if you're going to be in an area for a couple of years, or in a small starter house for a couple of years, it almost doesn't pay to buy it.
Yeah.
Right.
And that's why BTR is exploding. And
It
that's why
is.
we're capitalizing on it. In fact,
That's
we
why
just
we're going to be
launched.
building thousands of them.
That's right. I think we're launching today, right?
Yeah.
Today
we've
we
got
launched
Capstone. We've got
Capstone and Royce
Water's
City,
Edge.
Toledo. Yeah.
And we're going to be taking out the 350 unit BTR deal as well, not to mention the thousands of BTR units we're planning to bring online over the next couple of years at some of our large land sites.
Yeah, speaking of the large land sites, I think, who would have thought that, RREAF Holdings is building cities?
Yeah.
I mean, it's
I would.
it's literally building cities.
Yeah.
It doesn't surprise me.
I mean, you look at, well, heck, that's 2 cities right now that
Yeah.
we're working on. The one, just 20 minutes from here, that'll have 8,500 single family
That's
for
down,
sale.
That's down in Midlothian.
Yeah, half Midlothian, half Waxahachie,
right,
booming,
right.
booming.
With
I mean,
schools.
Best schools.
Yeah, I think there's 2 or 3 schools we're developing
Yeah.
there. The beach.
Abutting our property line on every single side is single family homes.
Yeah.
Yep.
And it's the last kind of enclave.
And that is where
For
the
development.
affordability in this metro area has to go.
That's right.
Because North
And we've-
Dallas families can't afford
We've
North
got
Dallas.
3,300 acres to do it.
That's
Yeah.
right.
What's cool
That's
about
right.
that is you're not only 20 minutes from here, but you're 20 minutes from downtown Fort
Fort
Worth.
That's right.
So,
Right.
And, with the, nowadays, I think, people want all the amenities. In the way RREAF Communities is set up is, the programmability, the highly amenitized communities with
Yeah.
the hiking, biking trails.
When you
the
get home,
soccer
you don't
fields.
have to go anywhere. You
No,
can hop
that's
on
right.
your golf cart or your bike, and you can
Yeah.
get around the entire community. There'll be
Go
a
to the beach.
grocery store, everything else will be there. So
Yeah. I think 2 or 3 schools, and then having all the different kind of food groups within the residential
Right,
community is
right,
neat. I mean,
right.
we're, selling this, the home builders, the Lennars, the D.R. Hortons, the Pulte's, selling all those, single family homes, but we'll develop multiple multifamily
Right.
communities. We'll develop townhome projects. We'll do a lot of the BTR
Mm-hmm.
within that. And so, you got a little bit for everybody in
Right.
different pods.
right.
And,
And then
We're doing
obviously there's going to be, some office and retail and storage and, some industrial.
yeah, I mean,
Certainly in our in our project down between San Antonio and
Yeah,
Austin.
I mean, that's
We've got an
hotbed.
industrial component there. Not to mention all the things that Kip just said. So,
Right.
as talking about Texas and the big the move from California. I mean that Caldwell
Yeah,
County that
yeah.
you're talking about, that is California.
That is
I
California.
mean, you've
yeah,
had all
yeah.
the tech companies and
Yeah.
Tesla and a lot of the
Yeah.
others that have just relocated their
Yeah.
big plants and corporate headquarters to
Yeah.
right down the street from
Right.
us.
Yeah.
Right.
Texas 130,
Yeah.
That's it.
where you can drive 85 miles an hour legally
Yeah.
and faster
and-
slightly illegally.
Yeah. Well, I was going to say, but I mean, you always get an extra 10. So, I mean, I think it's 95, right? It's 95 on the Texas 130. But, it's just, that's just such a booming
Yeah.
area. It's just,
We talked about the cultural shifts and people working from home and people being mobile and people being transient than they used to be. And that's one of the reasons why we launched the outdoor living platform, just because
Yeah.
there's been such a, COVID brought such an interesting dynamic, well, to the entire world, but certainly as it relates to real estate. I think back now, we formed that joint task force early on in the first week to 10
Yeah.
days of COVID. We formed a task force. We
Every
met
single morning.
every morning at 8:30. We were all on a Zoom call, and
2.5
that lasted
hours.
until 7:30 or 8 at night.
Yeah,
all
yeah.
the different ones all day long.
Yeah, and what was born out from that, from the beachside resort property standpoint, it was a new phrase. It's called drive-to destinations, right? People were wanting to stay with their family. They were wanting to not be locked necessarily in their home. They wanted to go do something, but they didn't want to get on a plane. They didn't want to get on a
Right.
bus or a plane or whatever. They wanted to drive. So they drove to our resorts, and it's very affordable, very family geared.
Right.
But we also saw the ability to communicate and to interact with our residents. All of our multifamily properties, we very proactively reached out to all the residents,
Yeah.
and we got them to commit to us
We
to pay their
assisted-
rent, and we committed to them to do any and everything we could possibly do to help get through the pandemic, and we did that.
Yeah.
So
I
We
don't think
assisted
we-
them with all sorts
No, I
of
mean,
programs and
I
helped educate.
don't think we
our
had any
collections
drop.
went up.
Yeah, I was going to say, I
They
think
went
our
up
collections
because-
went
Yeah.
up when a lot of other companies,
That's
I
right.
think their
They
collections just,
stuck their head in the sand.
that's right,
Yeah.
That's right.
But
So,
we took a very proactive approach, which I think is
paid off.
yeah.
paid off and
Yeah.
and commonplace
Yeah.
for our company. So we've got a very good team and culture.
Yeah, well, family oriented. I thought where you were going with that is, I think that whole, concept and learning that, that there is, learning, from not in school. What's that called?
Learn from the
In-home
streets.
learning.
Yeah, learn in-home
In-home learning.
homeschooling,
There
and
you go.
remote learning,
Remote learning,
remote
yeah.
working,
Right,
and all
right.
that.
That's
I
what
think-
bore it out.
Yeah. But that also kind of led into the
Right.
outdoor living that
Correct.
you're
Right.
saying.
Yeah.
And we
I mean,
saw, RV sales explode during the COVID era. And I mean,
again,
what-
supply and demand.
That's right.
disconnects.
and
That's right.
we kind of started digging in, and we built a secondary task force to start looking into the outdoor living and RV space.
Well, we spent 18 months, didn't we?
Oh yeah,
Yeah.
and we're still learning every day.
Yeah.
But what came out of that was the first RV1 portfolio.
Yeah.
And we'll have RV portfolio 2 to follow. But again, it's just understanding the supply demand economics, and RV sales, the recreational vehicles sales were up in the thousands of percentage points during COVID.
That's right.
And there wasn't nearly enough supply of well located, well amenitized, quality outdoor
Yeah.
living or RV parks to absorb that.
Yeah.
Well, I
to
don't
meet
even-
the demand.
To that point, I was actually asked the other day by someone that was really interested in the space. Well, Doug, COVID had an explosion of RV sales. That's great, but what happens when that tapers off? It
It
doesn't
doesn't matter. They're still on the road.
They're
They
still on the
need
road.
a place to
They still
go.
have to have a place to go.
Right.
Well, and also,
it's-
I think the way that things evolved has been interesting, and I think it speaks volumes to the way REAF thinks, and that is, taking the hospitality expertise
Yeah.
and then mixing it
Blending
in with
it.
blending it with to create, blending it with an RV
Right.
idea to create a segment that doesn't really even exist
It's a
today.
horizontal hotel.
Right.
Yeah, it's a horizontal
Yeah.
resort, horizontal hotel.
with no rooms to clean.
Well, not only no rooms to clean, but think about the cost per room.
Yeah, way down. It's just,
Well, so
but to be fair, what we're really doing that a lot of people haven't done is bringing the drop houses
the
or the
tiny
tiny
houses.
homes
Right,
to
right.
these to open
Right,
it to open up that outdoor living concept to non-RVers.
Right.
Yeah. Well, we're trying to not say RV around here. We're
Yeah.
trying to say, because it is a larger focus than just an RV.
Well-
It really is an experiential platform.
yeah,
Families.
experiential is
Yeah.
a good term for it. And I like to look at, our participation in the RV space as being very similar to the earlier days of multifamily for
Yep.
us when we were investing in secondary, tertiary markets. We were usually the
Pioneering.
first institutional buyers of a lot of these assets because there hadn't been any institutional attention
Right.
in that space before. And, we're seeing the exact same thing on the RV side. And, people do, and other groups do tend to look at us and watch. And, they say mimicry is the
Yeah.
best form of flattery,
Right.
but groups really do tend to follow our lead. And, we've already been seeing that a lot in the RV and outdoor living spaces. So, but, what we're doing there is going in and, we are going to be the first institutional buyer of a lot of these assets and buying them from mom and pops who don't have that institutional level experience operating and managing and growing revenues and implementing new business strategies at a lot of these parks, which just, in our eyes, gives us a ton of runway and a lot of upside for our investors. So,
And that and developing also,
Right.
Yeah.
brand
Right.
new deals.
Right.
That'll be, that Broken Bow deal that we're going to be launching, soon is going to be just.
Who would have
Yeah.
thought?
Yeah.
One of the top VRBO markets in the country.
I didn't even know.
Right up the road.
I had no idea.
Yeah.
you know.
but now that I know, I
Yeah.
hear and see
Yeah.
all of these,
Yeah.
everybody's always going to Broken Bow for
Yeah.
a
Yeah.
weekend
Yeah.
getaway.
Yeah.
But that'll be probably flagship because that'll be, with all the bells and
Yeah. It
whistles
will.
and just, that's what REAF's all about. And, and scale, everything
Right.
for us is scale. We'd like to every 2 hours all the way to, top part of Maine, all the way down to Key West. You're stopping at one of our
Yeah.
Outdoor living
parks.
resorts.
Yeah, that's right.
Yeah.
I think the thing that I'm personally that I'm most proud of You know, we could talk about all this success, and we are blessed that we have been a very successful company, and hopefully we'll continue to be. But you know, we've really got a family here. I mean, you know, the culture here at the company is very, very much family. Very little turnover here.
Let's call it a
lot of our
professional
kids-
sports team.
A lot of our kids are here. My son's here. Mitch, your son's here. Obviously, Graham is here. You know, we're building a legacy. It's a legacy business. It's not a business that's geared to sell, if you will. We don't have institutional presence at the corporate level. But the thing that I really love that we focus on is that we focus on our residents. We focus on our guests. We focus on their experience, their quality of life, the safety, the cleanliness, and also we focus on our investors, because our investors provide the fuel, the catalyst for us to be able to grow.
That's right.
And we have chosen, we chose it, guys, day one, that we were going to have a structure where we were more opportunistic, more flexible, not fund-based. And because of that, we've been able to push the accelerator and tap the brakes, you know, throughout the last 14 years.
Yeah.
And it has allowed us to grow the way we've grown,
Grow smart.
grow smart.
Mhm.
Sure, we've made mistakes, and we'll make more, but hopefully we won't make the same mistake twice.
Right.
But it's also allowed us to stay independent, and it's allowed us to you know, go where the value is, move, change directions, and be a whole lot more nimble than most companies that are, you know, approaching $5 billion in AUM. So
Yeah.
you know, all those things, I'm just
I
really,
think we'll probably,
not to mention the team.
Yeah.
yeah,
You know,
it is.
we have fun.
Yeah, we have fun. It's
Yeah.
it's a great atmosphere. It's a great culture,
Yeah.
and that's what I take great pride in. And I think that's why we have such low turnover.
Yeah.
Yeah. I
I
agree.
remember the early days when it was a much smaller shop and everybody did everything.
I joined.
Yeah, I haven't had to get involved in the closing in a long time. But then I was involved in closing. Gibbs was involved, you know, making your own closing spreadsheet.
Oh, yeah.
But,
Oh,
you know,
yeah.
I
But
still
now
make coffee in the morning.
But still, you know,
Nobody will drink it.
everybody
Nobody drinks your coffee. It's tar.
That's jet fuel.
everybody gets to do everything in the shop. So
That's right.
the kids that are here, there's low turnover, but you have an opportunity not to be pigeonholed.
Right.
That's exactly
Well,
You get
right.
to see everything.
We
get
hire a
done
lot of
and
young
learn
people.
A lot.
Right.
A lot of young
Yeah.
people
They
here.
ought to be
that's because
paying
of our
us.
training
We like
program.
to teach them, what do we call it? The RREAF way.
Yeah, the Reef Way, the Reef Academy.
Reef
and,
Academy.
So we don't have to take all their old bad habits that
Yeah.
they picked up at
Yeah.
other shops. We have, you know, our own training manuals and our own Reef Academy where, you know, we can teach all of these young people the Reef way,
Yeah.
exactly how we want it done. And
works well.
It works.
does.
It works really well. Something that you touched on is, you know, the investors kind of being our jet fuel, our catalyst.
Yeah.
But I think that, and Kip won't say this because he's a humble guy, but I don't think that any other commercial real estate company is going to treat their investors as well as we do and communicate
true.
as well as we
Very
do
true.
and make the decisions that we do, you know, in the interest of our investors. And some of the things that, you know, we're not going to get into here, nobody would probably have ever done for their investors.
Sure.
But, you know, we do a good job of keeping the investors kind of at the forefront.
Well, we
of
just
every
want to do the
decision.
right thing.
Yeah, and
You know?
that's the right thing. I
Right.
mean, you know, people are trusting us with their hard-earned dollars,
Yeah.
and you know, if we make mistakes or we're not hitting yields, we
Yeah.
need to be, you know, accountable. And you know, we shouldn't make money if they're not making
That's
money,
right.
and that's
That's
why
right.
we structure our deals the way we do. And you know, we've had a couple of misses, but we haven't lost any. You know, with the 5 platforms, we've not lost a single dollar.
Yeah.
But
Which
we'll always take
not
a
many
back.
can say.
That's right.
Yeah, we'll always take a back seat to make
That's right.
certain that the investors are taken care of.
Well, the future's bright here, fellas. I'm just happy to be a part of the team.
Yeah.
I am
It's
too.
gonna be fun.
It's exciting. I think 24 is going to be
Yeah.
just an exciting
Yeah.
year with so many.
We've been
year.
gearing up for it, haven't we?
Yeah, so many opportunities.
Yeah.
You know, we didn't even touch upon. You know, and we do it another time. But I mean, I love our extended stay
Yeah,
hospitality
extended stay.
vertical.
Again,
We could talk for another
a
10
whole
hours
other
about
example
it.
of how resilient the platforms are that we're in.
Yeah,
Highly resilient to economic swings. You know, we just the good thing is that we're sticking to our lane. We're sticking to where we know the value is. We're sticking to where the spreads are. We're sticking to where we can make some mistakes here and there. But at the end of the day, we're in assets that have been proven to outperform, even in downtime.
Well, with 30 years of experience, you've seen a lot, and
Yeah.
you've kind of figured out
Yeah.
every now and then, you know, what
Yeah.
works and what doesn't
That's right.
work. And
That's
I think
right.
that's why we're in the platforms that we're in.
Yeah.
You know, I've seen office, I've seen retail, I've seen, you know, big industrial.
You've done it all.
Yeah, yeah.
Well,
Made a lot of mistakes.
Yeah.
But you don't make them twice.
That's right.
So
well, we're going to continue to do these type fireside chats and try and touch and reach out to as many
we're
of our
going into
investors.
24, there's just going to be so much to
Right.
sit around and talk about.
Well, I'm
So-
sure our investors have questions and want to
Yeah.
know, you know, what we're thinking and what
Right.
we're seeing in the marketplace and hear our insights. And we're going to make, you know, a conscious effort to do this fairly regularly
Yeah.
so that our investors can hear kind of, you know, what we're thinking.
So in the meantime, Kip, what do we say?
we've got a lot of wood to chop.
Got a lot of wood to chop.
Get
We've got
chopping.
1.9 billion in target acquisitions.
That's
So
right.
we gotta
That's right.
yeah, we gotta close on those, get the due diligence
That's
done.
right.
And,
Well, let's
Graham,
get to
get
work.
back to
Let's
work.
go.
to work.
I'll go
Yeah.
get back to work.
Let's go.